Good afternoon, everybody, and welcome to the October 13th autumnal edition of Bull Sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by Ken Kavula, investor extraordinaire from the Central and Mid-Michigan area. Say hello, Ken.
Hello, everybody. How's everybody doing out there today? It's a beautiful, beautiful fall day here in Mid-Michigan.
And we are joined by our special friend and special guest, the master of investing in innovation and discovery, Hugh McManus. Good afternoon, Hugh.
Hi, everyone.
All right, so we are in the middle of October. The slides are basically simply to reinforce that most of you already know this. We refer to October as Red October around here, in honor of the red rabbit, and we refer to the S&P 600, small caps, whatever you want to call them, as rabbits. Some people call them red chips, but we endeavor over the last couple of months, basically for a quarter, to kind of double down on our hunt for promising, exceptional, emerging small companies. And we'll spend a moment talking about some of what we're seeing. We're not finished. There will probably be a good 40 or 50 more names added within the next week as we round out some of the more successful actively managed funds. But again, just our reminder that we're in that season and looking forward to our Halloween selection process of the best small companies. Morgan Freeman is there again as a reminder about our data. And we just love Morgan. Great voice. He's been God. He's been all kinds of detectives and just a whole lot of fun. And then he was going to take us back to the 7 deadly sins with a segue into one of his favorite disciplines that he wants to remind the audience about. So let's go ahead and crunch away. Again, our legal disclaimer, no investment recommendation whatsoever is intended. This is all about education, illustration, and demonstration. Emphasis on the demonstration. Views expressed are our own. We are here demonstrating techniques, philosophies, methods of the modern investment club movement according to NEIC, Better Investing, and Manifest Investing. Please do your own homework. Don't just dial up your broker because you hear a ticker mentioned in our presence. We do a monthly program called the Roundtable. It's almost always the last Tuesday evening of the month. So we're 2 weeks out from that. 8:30 Eastern time. If you'd like to be placed on a reminder list or have a friend that you'd like to recommend, you can email nkavula1@comcast.net, or you can go to the Better Investing Mid-Michigan chapter webpage and do it yourself. If you have any follow-up questions or anything of that order, send me an email at markr@manifestinvesting.com. All right, just as a reminder, we started these a little while back. We do kind of like to just kind of kick back and have an informal discussion of current themes and topics. Many of them are suggested by you guys, and we certainly appreciate that. This week, I thought we would go with, again, a few moments with the 7 deadly sins of investing, that best small company update that I just mentioned. And I do want to spend a few minutes just talking about, again, from the Morgan Freeman perspective of our data and analysis. But you can see there's a number of topics coming that will eventually bubble to the top. Many of you have asked about buybacks. It actually came up in a recent podcast with Joel Greenblatt and Barry Ritholtz. Some good moments on the notion of buybacks. And again, our favorite screens this time of year. Good session on the works of George Nicholson coming, Manifest Investing Chronicles, just about anything else you can think of. Please feel free to send us suggestions for themes and topics that you'd like to see covered. Any comments or questions, Ken?
No, there's a lot of things that I would like to talk about on this list. So let's get started. This is a good one today, Mark.
All right. Quick commercial here. Again, going back to some of the sessions that we had approximately 2 months ago, we covered George Gilder's book, Life After Google, as we talked about Google and Facebook and some of those technology companies, that's Roxy in the background singing along. And basically, it comes down to just encouraging everybody to think about the existential threats that can happen to our companies from time to time. Hugh McManus framed it as, do you remember America Online? And what can happen to even what seem to be the most stable companies. A couple of days ago, I watched a movie on Netflix, The Social Dilemma, and it covers a lot of those themes. I'm not sure I buy into the doomsday apocalyptic, or however you say that word, of some of what they were talking about. But it is kind of fascinating to watch a number of very high-ranking people who invented some of these algorithms and things that they're using in social media lay it out. I would just recommend it as a reminder and an underscore, especially as they attack the business model, the advertising-based business model and the stuff being done with artificial intelligence. Had either of you guys seen The Social Dilemma yet?
I haven't. It's a documentary, is it?
Yeah, it's kind of a drama / documentary.
Yeah.
And it's just provocative to make us thinking about some of the stuff that's going on. And go ahead.
Well, I was just going to say the fact is that if you look at all of the changes that have happened within the last 25 years, thanks to the internet and the web portion of that, etc., many of the innovations have been started literally in people's garages. I mean, Google, for example, did not invent search. There were very passable search engines before that. They just happened, as you said, to develop an algorithm which improved it greatly and made it much more user-friendly. Anyone could have done that. They put nice barriers around it. They added AdSense. They did a lot of interesting things. But you're right. People somewhere today in a basement or a garage, someone could be inventing something to overturn the entire world. You know?
Yeah, like
it's very, very different than 100 years ago when most of the economy relied on farming. There's no real super way to revolutionize things then, or to build a dramatically different car or whatever. Very different today.
All right. So
Mark, our friend Matt Spielman would like to weigh in. His hand is in the air, so I'm going to unmute him, okay?
Go for it. He's probably seen the movie. Yep.
Matt, you're muted on your side, so you'll have to unmute on your side.
Hey guys, you hear me?
Hey, Matt.
Yeah, we can hear you.
Hey, no, I haven't seen The Social Dilemma yet. I'm out of Netflix in my binging service rotation, but I did want to mention, because I know Mark, you foreshadowed that this would come up. So I happened to finish Life After Google early last week, and wanting something a little lighter, but facing a very long reading list, and now the time to do it. I actually picked up Ready Player One. And it's really interesting. That was a book that was written in 2012, and the essence of it, for those who don't know it, although there's a lot of 80s pop culture in it too, which fits my teenage years as well, so I flow with it pretty easily. But it's an online virtual reality system called the Oasis, which essentially sucks up everyone's time. And in fact, there's one quote that I thought was really interesting to this conversation. It says, it's a short quote, the Oasis quickly became the single most popular use for the internet, so much so that the terms Oasis and internet gradually became synonymous. And the incredibly easy to use three-dimensional Oasis OS, which GSS, the company that made it, gave away for free, became the single most popular computer operating system in the world. So it's kind of interesting, and of course this is in a fictional, dramatic, young adult sort of context, so there's a lot of things going on, and you have to believe in virtual reality. But I think that there's a lot of common themes in terms of the uses, but the pitfalls, both for individual people using the service, as well as corporate entities trying to harness this focus everyone has on it, that really speaks to it from a kind of a different angle, and predates Life After Google by 6 years. So I'm really interested to see. The author of Ready Player One is Ernest Cline. I'm interested to see who read who or who inspired who.
Okay. Well, we'll have to take a look at that one. Sounds interesting, and it's certainly a theme which grabs many of us. All right, let's go ahead.
Don't fall for the movie, however, Mark.
Don't opt for the movie?
Don't fall for the movie Ready Player One. It's less than satisfactory and misses most of the points of the book.
Okay.
Yeah, I like the movie too, but the movie is quite different. It's kind of a parallel universe kind of a thing. But you will miss a lot of the commentary of the book, the people's thoughts in it. So definitely need the book.
And that's often the case with books, yeah. All right, quick chart for the week. Just
Mark,
a reminder.
I'm gonna unmute Nalina also, who has her hand up, okay, or his hand up. Nalini, you're muted. No, you're unmuted. Go ahead.
Yeah, I had sent the email to Mark regarding the stock I was looking, but anyhow, the chart, I found it on the stockchart.com. But how to interpret this, can you explain? And there is, what is the MA in purple and MA in red? What does that mean?
Okay.
Can you explain, Mark, when you go through this?
No, we can spend a moment talking about that. Sure. Thank you. And we'll,
Thank you.
if we get a little bit of time at the end, we'll come back to Centene, which was the company you were asking about. So let's go. We'll try to get there too. What you're looking at here is just the value line arithmetic index. So it's the 1,700 companies in value line. And this is actually a 10-year chart with monthly price bars. Now, the price bars are pretty obvious. We can see that back in the spring of this year, February and March, we had that terrible moment in the stock market, that terrible drop, which is unlike anything that we'd seen for the last 10 years. The two lines that you see here, the MA, that stands for moving average. So in the case of the MA12, that would be the moving average for the last year. So that's this red line through the middle. The blue line is the moving average for the last 60 months or 5 years. So those are moving averages. They're used kind of like to measure a statistical trend. And many technical analysts will look at a moment when that is breached or broken through, like you see there, as basically an algorithm to do something. So that's what the MA stands for. Up at the top, that's our relative strength index, RSI, and this one happens to be a long-term measure of it, 12-month trailing RSI. And again, anytime that is above 70 for a particular stock or a group of stocks, like this is a group of stocks, anytime it gets up into 70, that's thought to be overbought. Overheated is maybe another way to think of it. And you can see that in both of these instances, there were periods of time that were pretty sluggish or turbulent, following that quote unquote overheated moment. So that's the only point we're trying to make with this slide, that we're not yet overheated in the current conditions that you see here, but there has been an extremely substantial recovery from the levels in March. All right, here's that same look on the NASDAQ 100 stocks, and that has also been pretty much red hot, recovering from levels down around 200 just 4 or 5 months ago up to 300. So you're basically looking at 50% returns on the average NASDAQ 100 stock in the last 6 months. Again, this is just a 6-month chart. So these averages are in days now. You can see it says daily here. So that moving average, that's basically the moving average over the last year or 200 days. And the 50 is the 50-day moving average. That is used very commonly by technical analysts when they're making their type of decisions. Here you see that overheated moment back early September. One of the reasons I wanted to show, just as a case, PayPal is certainly in the NASDAQ 100. Notice that PayPal has attained a price level of 200, almost back to its 210 level from a few weeks ago, coming all the way back, though, from actually 80. It was actually 80 just before this price chart starts. So you're looking at a company which has nearly tripled in price. one of the reasons that we're talking about this is, I got a question, we're going to show it in a second. But again, remember that pretty much all other things created equally, when the stock price triples, the return forecast, or the PAR, is probably going to plummet. Again, the return forecast is often going to be inversely related or opposite to the stock price. So when the stock price triples in a few months, you end up with a company that has a fairly limited return forecast going forward. And that was the source of this question. A couple things I want to talk about here. PayPal had dropped down to a PAR very close to zero as of 10/12/20. However, the date for the latest data update is 5/29/20. I can't explain why that update date was messed up, but that's basically bad data right there. Any company that's in the Value Line Standard Edition is never going to be more than 90 days old because they get updated every quarter. So I can't explain this, and I'll just leave it as a question mark. But the other thing I want to point out, and we'll look at this in a second, most of the influential, important data is updated all the time. So even though this says 5/20, there are aspects of PayPal that have been updated within the last couple of days, and that's always true now, thanks to the data and Morgan Freeman smiling up here. So the thought I want to leave with everybody is that date is of limited value. In fact, I'm thinking of changing it to audit date when we really take a look at it top to bottom. So let's take a look at PayPal just to illustrate some of what we're talking about here, because I think it does show a few things. Here are the visual analysis, the business model analysis for PayPal. And we note a few things here. First of all, that price has doubled just since February. We see that here. The return forecast over that period in time has dropped from 6% to 2%, or approaching zero in some cases if you use a lower PE than that 45. But notice that, look down at the bottom here. The Value Line low total return forecast has actually cratered and gone to -16. Again, it's symptomatic of a company where Value Line has trouble keeping up with a fairly early stage, rapid growing company. Notice that the points on the charts up here almost seem to be out of place. That one and that one. They could be right. They actually might be right. But notice how this price chart here for the 3 to 5 year forecast doesn't line up very well with what we're seeing here either. So again, they could be right, but based on this model, I have a hard time seeing the pessimistic nature of the information you see displayed. This growth rate here has been fairly consistent at 14 to 16%. So I have a hard time imagining a 3 to 5 year estimate as low as the one that's shown here. The other thing that's kind of neat, and many of you in the audience are already familiar with it, this projected return on value that we've been doing for many companies is much more stable, and it does illustrate an overvalued situation. Excuse me, an overpriced situation with a low projected return on value. That's down in the lower group of companies. So again, many of these numbers, including the trailing 12 months and for sales and things like that, the numbers that are actually forming those numbers here, these numbers are updating continuously. The ones that I'm circling now, these are updating all the time and how they affect those trends. And it's kind of interesting to watch them change daily. So again, the date's less important as what's going on with the numbers behind the scenes. Any comments or questions on that, Ken?
Well, I'm wondering, you indicated that Value Line is having a difficult time with early stage companies. I'm also wondering if Value Line has a little bit of problem with companies that might be transformational, that might be moving into technologies and taking market share from traditional technologies. I really do think that some of these financial tech stocks are kind of reshaping the way that we bank and the way that we purchase things. And maybe Value Line hasn't caught that at this point yet. I can't say for certain, and I don't have a large enough database to justify that as a generalization, but I do know that PayPal is certainly with the group of stocks that are rethinking the way that we're going to buy things going into the future.
Yeah, and in fact, you and I had talked about, part of the trouble with Value Line. You can see it's right here. Their average PE ratio, in fact, for the current edition of Value Line is still 30. And it's actually fairly easy to get to a number, let's just say 40-ish. And there's not a whole lot of information to go on, with a company like this. And I do think that much like many of us in our community, myself included, there have been times when we've been overly conservative about this type of company. And I do think that this is an example of a company, and there's better examples, where the projected return on value, which is less sensitive to the PE, it might be very interesting to look at reconciling PE expectations for many of these companies. I want to add this as a future session where we can carefully walk through a few examples, and we'll actually find ourselves justifying some of those golden rules about, looking at a company that maybe has a PE of 75 or 90, according to some published source, but as you reconcile it with the PROV analysis, you end up putting those 30 or 40 limits in, much like we talked about years ago with our stock selection guides. I know that's
Mark,
something you find interesting, Ken.
Yeah, absolutely. And Mark, I'm questioning the scale on the bottom of the PE graph. Is there something wrong with that scale, or are we missing some PE bars? Or
you mean in terms of here, this area here?
the actual years? It looks like we have a bar for 2016 and one for 2017. But don't we have any PE values from 18 and 19 at this point?
We do, but Value Line calls them NMF, which means they're up here somewhere, and they don't know.
Well, I understand the NMF, yeah, but is that coming because the earnings have been adjusted into negative territory? Is that what we're talking about?
I don't know the answer to that.
Okay.
I don't think so. I think it's just a matter that they got slightly high and they just kind of blank them out of the spreadsheet.
Okay.
All right. So PEs are tough on companies like this. There's no doubt about it. I do think that the PROVE stuff makes that kind of stuff easier. So we'll come back to it. All right. Here, Ken and I thought we would at least air out. This is very, very preliminary. What I did is I took our list of companies that are in the database. Like I said, there's going to be a bunch more here shortly. I limited them to a growth rate greater than 12. So greater than 12, and then basically ranked them by their manifest rank. So they should have decent quality in combination with a return forecast that is fairly formidable, or a pretty strong projection going forward. So this is the type of list that Ken and I will be wrestling over, auditing, arguing about. For example, I can tell you there's a couple here that will go away very quickly when he and I sit down together, the first one being Facebook, because he won't let a $75 billion company in there. So that one will be gone. What else are you taking off the list right off the bat, Ken? Tencent?
Well, I'm not pleased with Tencent on that list either. And to be honest, I'm not pleased with Air Lease or Align or EPAM.
Okay,
I think they're all great companies, but I don't think they belong on the list of best small companies.
So we're worried about EPAM. So you get a feel for what we'll be talking about. Air Lease, again, we had Matt Spielman a few minutes ago, one of his favorite companies. It has been disappointing for a while. About the time we give up on it, I just know it's going to take off. No pun intended. There's just a number of
Yeah,
companies on here.
I must have just skipped right over Advanced Semi Engine.
Oh.
And I don't even know what the name of the company is, Mark. The ASX,
Well, the
Advanced Semi, what is it? Engraving and.
we'll get rid of that one too. Anyhow,
All right.
what you're getting a feel for is we'll be going down the list. There's an awful lot of insurance and banks on here. Most of those will not survive as we subject them to excruciating analysis. But there are a number of companies that have been around. I love Chef's Warehouse as a company. It's a little bit big for the list, but got a lot of potential. Some of these will have fairly low PROVE numbers, like this one reaches out to me, and I would really want to check that over carefully. That's suggesting that American Tower is not as attractive as it appears to be on here. So it'll be kind of fun to go through those. One of the things that you will see us trying to do this year, I would jokingly said to Ken, I want 15 Neogens and 5 companies that Hugh McManus would love. 15 core companies and 5, perhaps early stage, provocative, exciting companies, for our list for the next year. Now, Ken,
Mark, would the financial structure of a REIT have anything to do with the owner's proof number?
well, for that number, the proof is basically taking a look at the book value plus the market value in the denominator.
But what I'm suggesting is, might it give us a proof number that's not comparable to proof numbers from manufacturing or services companies?
We've made every effort to make any asset-based company comparable, but it is one that Greenblatt throws up his hands. He won't even think about his version of projected return for the financials. So I think there is a way to get there, but we'll be kicking that around pretty hard. All right. So that's the start of the list, and Ken, we will be wrestling soon. All right, so let's go ahead. Now, you missed this one, Ken. I know that you're immaculate and without any sinful nature when it comes to investing, but Hugh kicked this one off for us last week. I don't actually have the book. Hugh, did you actually get a copy of this book and take a look at it or not?
No, I didn't. I mean, I think we independently came up with the idea of the 7 deadly sins of investing, and basically looking back at things that I didn't do that I should have done in the past. And if they were sins, I mean, obviously things that prevented us from having a better outcome overall. And from that, we then tried to map the favorite 7 deadly sins, from the biblical background, and see how they map on to investing deadly sins. And then we found this book by Marty Furtick, which I haven't actually read yet. And it was all driven by the fact that it takes me a huge effort to get over the fact that I use margin. And I have used it a lot recently and in the past, but I always feel guilty about it and wrong. And I've never been bitten by it. And I know that I'm constantly listening to the idea that you could buy something on margin, you're opening yourself to a huge risk. It's not necessarily the case,
Mm-hmm.
that it's a huge risk. It always is a risk.
Well, actually,
and I wonder, is an example where I overcorrected?
Right, and Ken missed last week, but he came into the room today with an observation about newer investors at Robinhood, and I said it really dovetailed with what you were talking about last week. Ken, did you want to share with the audience?
Well, it was just a discussion that I heard on it, and it wasn't even on CNBC. It was on a different business outlet that I was listening to this morning, and they just were making the point that they felt a lot of the archetypical Robinhood investors had moved from investing in common stock like Tesla and Facebook and Apple and companies like that. They've moved on to options now, and they're doing option trading because it gives them a higher high. There's faster money to be made, and there's bigger money to be made in some cases. And I then turned on my favorite CNBC, and listened to Kramer and his buddies talking about exactly the same thing. And how about the fact that it could only turn out bad in the long run if you didn't know why you were doing some of the things you were doing. They were relating stories about listening to some of their investing friends following Robinhood now and saying to each other, investing's gone back to being easier like it was in the 50s and 60s when stocks moved on news. And they were saying all you have to do now is know that Amazon's going to have a Prime Day, and so you invest in Amazon because you know it's going to go up. That seems awfully simplistic to me, but it's working right now, evidently. And I guess that's one or two or three of the deadly sins all rolled into one or two behaviors, isn't it?
I would, I think it's dangerous, and it can actually discourage people from evolving and becoming long-term investors for sure. No doubt about it. All right, so one of the things I wanted to point out, and we'll probably spend just a few more thoughts in this area here in the incoming weeks, but over at Ritholtz Wealth Management, Josh Brown and a couple of his friends, Ben Carlson and Michael Batnick, put together a presentation on the 7 deadly sins. And here's one of their slides, financial envy, and some of the characteristics that they point out. And it is something that I do think we can fall victim to. And they did a nice job of going through the slides. So I thought I would just spend a moment in True Confessions. By the way, when we invited anybody to do True Confessions and send in their thoughts or confessions about committing any of those sins, none of you did. So you're all pure. No, when we take a look at companies looking over their shoulders, companies that have been successful, especially the actively managed funds, I don't consider it to be a sin of envy. We are trying to learn from those who seem to know what they're doing and basically earning excellent grades on their report cards, if you want to think of it that way. These are the 20, as of today, top 20 funds that have beaten the market. You can see that number 20 checks in at 6.3% better than the stock market. So that falls into that super investor category, that promised land that a few investment clubs reach. So these are all entities that we delve into as we search for our small companies and just investing ideas in general. So I don't consider it to be a sin to do that. I do lust over some of those returns. I mean, Morgan Stanley Centerpoint at 29% over these last couple of years. I mean, I'll admit to some lust when it comes to that one. But just to give everybody some idea that we do try to track the companies that all of these entities find interesting. All right, how about a little bit with lust? I think Hugh and I both have to plead guilty to a little bit of lust with Tesla. Do you feel lusty about Tesla, Hugh?
You add my name to the list too, Mark.
I do. And as we're talking about, I'm kind of surprised that I missed it, because it's not that there was lack of information that the company existed, you know. It was up front and center, and had been looking at it for I think it's way overvalued now, just for what it's worth. But
now, yeah,
way overvalued. I would price it closer to 40 to 50 maybe, if even that, but still.
Yeah, I can remember sitting in the audience at a Motley Fool wealth management conference many years ago, probably 7 or 8 years ago, when they were talking about Tesla. And I'd been sitting there all day admiring my own work and, you know, a lot of the companies that I had been tracking, and pretty much agreed with them. And then they brought up Tesla, and they were talking about the huge potential. You talk about obsessing over the past and what ifs. I mean, I'm sitting there giggling about, you know, these guys and what they were talking about. I got to say, they were definitely on target with many of the assumptions and expectations they had for the company, and I probably should have stopped giggling and just listened carefully, even back then.
Do you think, Mark, that where we live, you and I had a bearing on how we felt about Tesla for so long?
Well, yeah, I definitely think, I mean, I live with a person who works for a car company. So thinking about Tesla as a car company, you know, that has more market cap than all the other car companies combined, that just sounds scientific-ish to me. And I was very dismissive. And then one day, about 6 months ago, Hugh hit me over the head with a 2x4 in the shape of a roofing shingle. Says, you know, they're not just a car company. And, you know, and when you start looking into the batteries and the fact that they are now making shingles which generate electricity and look just like regular shingles and roofing tiles, and you start digging into that kind of stuff, and then he points out they're drilling a tunnel from Las Vegas to Los Angeles, and, you know, it's not just a car company. And somehow I think I plead guilty, Ken. I was blinded by that.
I kind of think also that Musk was his own worst enemy with anybody that thought about investing. You know, you hear all the time. You hear in better investing, and you hear in seminars on being safe. You hear management. And even though he's recognized as a real forward thinker and perhaps a genius, the irrational parts of his behavior really scared the bejesus out of me a little bit when it came to putting money behind him.
I would agree. Any closing thoughts on that, Hugh? Any confessions?
No, I think that's a good point, because there was a lot of information up there about Tesla, but there was a kind of how will I phrase it, a snake oil flavor to the company.
That's a great way to put that, Hugh. A wonderful way to put that. Yeah.
So I had an immune response to the company, and so never looked at the financials, you know.
So with that immune response, let's talk.
Yeah.
Let's talk about discipline. And go ahead and Hugh, take us away with the fundamental stuff that keeps your feet on the ground as an investor, as you practice discipline.
Yeah. Well, so one of the things that I have done, and I appreciated doing it way back in the 90s, even though I didn't really understand the full import of this approach, is to analyze the inventory of a company, especially a manufacturing company, and particularly a company that's selling a product that can go obsolete. Because if you look at the various components that make up inventory, the parts to assemble a good, you've got the raw materials. So view those as eggs if you're making an omelet. You have the work in progress. So you can view that as the batter. So it's no longer an egg and you can't move it back to be an egg. So you're committed to go forward or stay where you are. And then finally, the final good, which is the omelet. The omelet can't go back to become the batter of the egg anymore. And the thing is that you don't find that information in a regular filing by the company, in the regular annual or quarterly report. You generally find the breakout of inventory in the 10K, which is the annual report, or the annual filing, or the 10Q, the quarterly. And it prompted me, and I'm in the process actually of looking at the inventories of Tesla for the last 10 plus years. Haven't finished that yet, but it prompted me to dust off an old slide, which is a slide that just goes through the major SEC filings and just summarize those in case people aren't familiar with them. When I own a company, I generally select the option on their website to have major SEC filings, usually the 10Q and the 10K sent to me, sometimes the 8K as well, but I'll run through a list and explain what they are. And this is an example of Tesla's page, which I think is actually a bit clunky, but it's a page and there's 92 of them and they go back to their filings right at the start. You can also download them directly from the SEC on a thing called Edgar, the electronic filing system that they have. So a really good resource. So we skip along, we'll just go through them in one by one. The 10K is the annual report. It's not glossy, but it contains an awful lot of information, including the breakdown of inventory. And if you're into investing in REITs, you get probably there's 7 different lines there telling you what properties they hold and in what state, as they progress from just from pure land, undeveloped real estate, all the way into final commercial property or housing or whatever. So the 10K contains a lot of information. It's called a 10K, it's not a 10A, because anytime you see A in an SEC filing, it usually means it's an amendment. So for some reason, they decided to settle in K for annual. And then the corollary to that, which is the next one, is the 10Q, the quarterly. I used to love quarterly reports, downloading the PDF. They were short, 10, 20 pages, even 25. After Sarbanes-Oxley, these things are massive, 70 to 100 pages. But they don't really contain a lot more information. They have a standard setup, 6, 7 sections, and the risk section has been added, and it contains a lot of useless, as far as I'm concerned, detail, but some of it is quite interesting. But it does provide interesting financial information in the company, and for a manufacturing company, it provides a breakdown on inventory. And this classically was a very good way to analyze what's going on in a company. Just in summary, if I may, if you see a buildup of raw material, it means that the company has suddenly realized from its sales staff that it's not going to be able to sell things as readily as it could, but it may be contractually obligated to buy these raw materials. So it cuts back on production. So you'll see raw materials rise as things slow down. You'll ultimately see work in progress goods and finished goods rise and put into inventory. You'll see behaviors like revenues increasing, but profit margins shrinking as people try to push things out the door. And you will see inventory turnover slow down as well, as people are giving better credit to companies to buy these things because they want to get them out of their warehouses and into somebody else's warehouse. And people are slowing payment. And just so you know, back in 1999, in fact, in 1998, when you looked at companies like Dell particularly, and Lucent, and later on Cisco, you saw inventories go crazy right up to the end of 99 and into 2000. There were very, very clear signals, just looking at inventory, that something was going on in the .com or the computer world, at least the hardware. You can't really do that with a service company like a Microsoft. They don't really have inventory. That's the distinguishing feature. But by looking at a hardware company like Compaq Computer back then and Dell, Cisco Systems, Lucent, companies like that, you were able to see that something was going to happen. It turned out to be a nasty downturn, but it was clearly signaled. We move on to the next one. The form that you might see, well, an 8K is basically if the company issues a press release. If something material happens, they call it an unscheduled event. But if something material happens, they'll file an 8K. And as I said about the 10K, it's a 10K, not a 10A. A means amendment. And sometimes you'll see an 8KA where they amend something that happened. They have 4 days to file this, by the way, after the event happens. And if you sign up for SEC filings, you'll see a lot of 8Ks.
So
skipping along to the next one. Sorry, was there
Elon Musk gives one of his tweets, they end up filing one of these forms.
Yeah, they're required to. It's material they're required to. The S1 is one of the oldest forms. It's the registration statement. Dates back to when Kennedy started the SEC after the Securities Act of '33. It's also called a prospectus. It is the initial statement by the company of its financial position. So it drops its undies and shows everything to the public. And it has to be filed before it is making an offer to a public audience, a filing to go public. And then there are related S forms, an S3, which is used for a secondary offering, etc. But they're all the same. They're all the same format. And they're generally called a prospectus. So if you're looking for a company's prospectus on the investor side, it's an S1. And an S4 has got to do with details of a merger or an acquisition. There are a couple of hundred forms that they can file, but these are the ones that you'll see most commonly. And then skipping along to the next slide, the S8, details about a stock option plan. This has to be filed if they're making these securities available to employees as an incentive program to do better and increase value for shareholders. Another one that you'll see quite often is a proxy statement, and it's often called a proxy statement. It's actually a DEF 14A or an A14A. This is not an amendment, but it is a proxy statement, and it's actually two forms, and you'll see both of these generally when a company is issuing a proxy statement. It provides details of what companies are going to be asked, shareholders rather, are going to be asked to vote on in the shareholder meeting, and details on the compensation for board of directors and employees, key employees. So skipping along, this is a form that you just see relentlessly if you sign up for filings, and you actually don't decline to receive this one. Form 4 is the one you'll see most often, but there are forms 3 and 5 as well. A form 4 details transaction made by an officer or an insider, if you will, of the company, member of the board of directors too. If it's the first time they've done something, so they just joined the company and they're awarded stock options or the exercise stock options or whatever, they'll file a form 3. And if they delay in filing, because I think they have 10 days to file after the transaction occurs, they'll file a form 5. That's a rarer form nowadays. And a 144 is an intent to sell, but you don't see that as often. At least I don't. A 13D, another form that you might see now and again. It's really not that common, but pay attention to it when you see it because it's got to do with activities and people who own a big chunk of the company, 5% or more. This has to be filed within 10 days as well. And what triggered this effort to explain this background is looking at a 10Q. I'm sure everyone here knows about what a 10Q is, but this is just an excerpt from the latest one that was filed by Tesla. And you can see that they detail the work in progress, the finished goods. They actually have service parts as well. So they break their inventory into 4 components here. The classic way to do it is raw materials, work in progress, and finished goods. But here they show service parts as well. And I will go in, if we have time next week or maybe the week after, go into this in more detail, depending on what has already been scheduled. And looking how these change over time, show you something about what may be happening to the company. And I might actually go back and dig out the presentation on Lucent and Cisco, because Cisco clearly signaled that there were going to be inventory and actually revenue problems or challenges coming into the year 2000. And I think there might be one more slide. Yeah, here's a great book by Thornton L. O'Glove. If you can find it, great. But it has been out of print for a while. It's called The Quality of Earnings. And it goes through a lot of ways that companies can gussy things up to look better than they actually are, getting up to the point of illegality, but maybe not crossing that line. And one of the ways to stress test earnings is to look at inventories. And he goes through this as an example in different ways. For companies, by the way, of the 40s and 50s era when this book was written, so may not be generally applicable today, but I tend to like books like this because you get to learn the principles behind this analysis of looking at changes in raw materials and comparing it to things on the income statement and how those change as well. But it has one chapter dedicated to this sort of analysis. So I just wanted to bring this book up to the fore if you have never seen it. It may be available at your local library, it may not. But if you can get hold of it and read it, I think it's well worth the read.
Good stuff, Hugh. Yeah,
Back to your host.
I remember vividly the work you had done on Lucent back in that time frame and had shown that stuff. Ken, you had something on your mind?
Yeah, Mark. All of these documents that Hugh is talking about are PDF documents when you download them onto your computer. And I like to tell audiences all the time that any PDF document is immediately searchable by using Control and then the letter F. Control and F will search any PDF. So if, let's say you're looking at the 10Q for an increase in dividends or what the current dividend is or something along those lines, you can put in a search for those words and go immediately in the document to where those words are and what surrounds those words. That works for any PDF document, and that includes almost everything on the SEC site.
So if I do Control F and where are they stretching the truth, will it take me to the entries that are classified?
If you ask for that phrase exactly, it will search for that phrase. I don't know if it'll give you any, Mark, but
all right.
But I'm thinking that some of these documents are, as Hugh alluded to, they're quite long.
Yes.
And if you're looking for something specific or even a list of specifics, that Control F can really be a time saver for you.
The good thing about them is they all follow the same pattern. It's a filing with the SEC, and they have a template that companies have to follow. So it's a bit daunting the first time you crack open a 200+ page 10K or 100 page 10Q, but once you get used to reading them, the document becomes quite short. There's only a couple of places that you might want to go and look, and you just get familiarity with the document, and therefore you can read it a lot more quickly, or at least review it more quickly.
Well, you can search for topics, probably even the thing I just said, at YouTube, Manifest Investing. Go ahead and enter your phrase in the search bar and see what you can find. You can certainly find some of the things we've talked about over the last several months here today. Please go ahead and subscribe and like when we do something that pleases you. Hit the like button. Ken, do you want to go ahead and talk about our current efforts?
Yeah, the Mid-Michigan chapter of Better Investing and Manifest Investing, we're going to jointly sponsor another conference. We know many of you were our friends that came to our conference last May, and we're going to do a 3-day conference again. This one's entitled Successfully Investing. I think there should be a 2 after that, Mark. And then we're going to kind of subtitle this one The Stock Pickers. Registration materials are going to go out to our guest list sometime by this weekend, and there'll be a URL for each of the classes that you might want to take. There's 4 classes and a panel discussion. They're proven to be quite likely, and we'd love to have as many of you as want to come. It's absolutely free. All you have to do is sign up for it. Again, if you want to be added to our guest list, go to the Better Investing website. Under chapters, look for Mid-Michigan chapter. And my wife has made it now so that the sign up for the guest list appears on the home page. As soon as you land on the Mid-Michigan homepage, you'll see the sign up there for the guest list, and you can sign up yourself, or you can get sign up for any of your friends. This is on the non-member side, so you don't even have to be a member to be added to our guest list. And once you're on our guest list, we'll let you know about all the things that we're doing for free and all the things that we're co-sponsoring with Manifest Investing for free as well.
Okay, thanks, Ken. I think I'm going to go ahead and shut down the recording. We'll leave the floor open for a few minutes and answer some questions, but let's go ahead and thanks everybody for coming, and everybody get out there and send us your best small company ideas as we continue our hunt during Red October. Thank you, Ken, and thank you, Hugh.
Thank you.
You're welcome, Mark. Thanks, folks. It's great being here.